Well, China and the United States have announced an easing of trade tensions, with both countries lowering their tariff barriers. Joining us now to discuss what this means for China's economy and markets is Haining Zhao, Vice President and Director for Asset Allocation Research with TD Asset Management. Haining, thanks for joining the show.
Thanks for having me.
All right, so as mentioned, we have a reduction of tariffs in both China and the U.S. What's your reaction to this development?
It's certainly very positive, both for the market and for the world economy. And it is positive both in terms of headline as well as underlying details. So in terms of headline, drop of tariff rate from 145% to down to 30%, that is a huge drop. So that is certainly exceeding our expectation. So before, we were thinking about it is probably somewhere around 40%, and that is after long and hard negotiations. And just after one meeting, we're already down to 30%, which is very encouraging. And in terms of underlying details, there are actually a lot. For example, in the official statement, there is no mention of purchase of energy and agricultural products, no commitment on further purchase of Boeing airplanes. So all of these details can come up later, which means there could continue to produce positive outcome. And also fentanyl, that is another bright spot. So from China's side, the Minister of Public Security actually joined the meeting, and there seems to be some surprisingly positive progress there. And as we know, the fentanyl-related tariff is 20%, so there is definitely room for cut on that front as well.
Okay, so there's definitely some optimism, and the U.S. has characterized this as a reset in relations, and President Trump says he actually may speak with the Chinese president later this week. What will you be watching going forward?
Well, people talk about a reset, but actually we can look at it from different angles. On one hand, if we look at the near term, it is indeed a very positive reset. Essentially, we are going from an escalation stage going to a de-escalation stage, which is certainly positive. But on the other hand, I think what is not changing is the great struggle between those superpowers is not ending. So we have to be very kind of sober and prepare for the future volatility. And in terms of what we are watching for, I think number one, fentanyl, as I mentioned, because 20% is a lot. It could easily be cut in half or completely be removed, which is certainly positive for the market. And we also have to watch out for what are the potential items that will go into the negotiation agenda. For example, are China further opening up? Are there any concrete measures on that front that it will be worth watching? A third interesting area is, as we know, U.S. Don't want general decoupling, but they are choosing selective decoupling in strategic industries such as AI and semiconductors. On those front, it will be interesting to see how much decoupling will there be and if it will cause supply chain disruptions.
Yeah, there's still a lot of details that need to be worked out. How has China's economy managed through this recent trade turmoil, and how much of a boost could this tariff reprieve provide to China?
Right. So far, I think that China managed its economy in the first quarter really well, partly due to two reasons. Number one, it's the pull-forward effect, stemming from the tariff. The second is the organic recovery of the Chinese economy. So in terms of that pull-forward effect, actually, let's look at the overall Q1 Chinese economy performance. In Q1, the GDP is growing at 5.4%, above the full-year target of 5%. The retail consumption is a tad better than last year. The infrastructure investment is also at growing at a robust pace, around 5%. So the only area that is dragging is the real estate investment, still down % year over year. And in terms of export volume, it is actually still growing. So for example, in April, the export to the US dropped 21%, but the overall the export volume still growing about 8%, which is quite amazing. But the full tariff impact is not completely reflected in the April number, given that all of the super high tariff happened at the latter half of the month. So in May, that impact might be a little bit bigger. But in the meantime, the policy support is on the way. For example, a couple of days ago, we are seeing In terms of monetary policy, the PBOC is cutting benchmark interest rate by 10 basis points, cutting reserve requirement ratio by 50 basis points. So all of these support are on the way.
So there's additional government stimulus coming from China.
Yeah.
Okay, amid this backdrop, how should investors be thinking about China's markets right now?
Yeah, we have been pretty constructive about the Chinese equity market since start of the year, not because of very low valuation, but because of the innovation that we observe from the bottom-up company level, and also the competitiveness of their products. Tariff is certainly a headwind, but that tariff headwind is also abating. And I know for a lot of institutional and retail investor, China is kind of out of benchmark play. It will take a lot for people to add China exposure, and they really have to understand it really well to be comfortable with that. But I think even for investor investing in a developed market, it will be worth watching the Chinese economy and markets, because many of these innovations, it will have huge spillover effect to the rest of the world. And by watching it, monitoring it closely, it will position the investor better for what's coming.